What if I told you there's one single financial document that can instantly tell you if a business is truly rich, completely drowning in debt, or perfectly healthy? Welcome to The Explainer. Today, we're diving into one of the absolute most important tools in both business and personal finance. By the time we're done here, you're going to be able to read a balance sheet like a pro accountant. And honestly, this is absolutely essential if you ever dream of starting your own company, investing, or just, understanding how money actually works. So let's start with a relatable little mystery. Imagine two businesses. Business A owns massive, highly expensive equipment. Business B, on the other hand, just has 10,000 dirhams in cash. Which company is actually richer? Well, it's kind of a trick question because right now, you really can't answer it. Having cash or equipment alone doesn't give us the whole story. Why? Because businesses also owe money. They might own buildings, vehicles, and inventory, sure, but they could also be heavily burdened by loans. And that hidden reality is exactly why accountants created the tool we're unpacking today.
Section 1. The Financial Snapshot.
Let's get our terms straight right off the bat. A balance sheet is a financial statement showing three specific things: assets, liabilities, and owner's equity. Crucially, it shows all of this at one specific point in time. You can think of it like taking a financial selfie. See, unlike an income statement, which tracks how a business performed over a whole month or year, the balance sheet just stops the clock. It captures one exact frozen moment in a company's financial life.
Section 2. Assets and Liabilities Explained.
All right, let's break this down. Assets are simply everything a business owns that has value. We're talking about cash, the inventory sitting on the shelves, office furniture, the building itself, equipment, computers, vehicles, and yep, even the money that customers currently owe you. Is a company laptop an asset? Absolutely. Is cash an asset? You bet. And here's a super important tip for you. The defining characteristic of these assets is that they help generate future income. They're literally the tools that build wealth. Now, on the flip side of that, we have our liabilities. This is everything a business owes. We're talking bank loans, credit cards, unpaid bills, mortgages, salaries you owe your employees, and taxes payable. But wait, here's a common mistake that actually surprises a lot of people. Is a bank loan automatically a bad thing? Actually, no, not necessarily. It really depends on the context. Bank loans can actually help businesses grow and scale much faster than they ever could on their own. The crucial takeaway here is that not all debt is bad debt. Section 3. Calculating true net worth. Okay, here is the absolute core equation you need to remember. Assets minus liabilities equals owner's equity. It's a very straightforward, highly logical calculation. Owner's equity is simply the owner's true share of the business. It's exactly whatever value remains after completely paying off all of the company's debts. Let's run through a quick mathematical example together to see this in action. Imagine a business has 500,000 dirhams in assets. We subtract their 200,000 dirhams in liabilities, and boom, we're left with exactly 300,000 dirhams. That 300,000 is the owner's equity. It really is that straightforward. And this brilliantly illustrates a concept that goes far beyond just corporate boardrooms. See, business net worth is calculated by taking business assets and subtracting business liabilities. But personal net worth works in the exact same way. You take your personal assets, like your house, your car, your savings, and investments, and you just subtract your personal liabilities, like your mortgage, your car loan, or your credit card debt. The exact same financial rules that govern massive global businesses apply directly to your everyday personal finances. Let's look at a quick, real-world example of personal net worth just to lock this in. Say you have 800,000 dirhams in total assets, and you subtract 250,000 dirhams in liabilities. You're left with a very healthy net worth of 550,000 dirhams. This is the exact number that tells you where you stand financially at this specific moment in time.
Section 4. Real-world cafe example.
All right, let's put it all together and examine our imaginary local cafe. First up, the assets. The cafe has 50,000 dirhams in cash, 80,000 tied up in some really nice espresso machines, 70,000 in comfortable furniture, and 20,000 in coffee bean inventory. Add all that up and it brings our total assets to 220,000 dirhams. But for liabilities, the cafe has a bank loan of 60,000 and they owe their suppliers 20,000. So that means their total liabilities are sitting at 80,000 dirhams. So just doing this simple math here, we take the 220,000 dirhams in total assets and subtract the 80,000 in total liabilities. This reveals a final owner's equity for the cafe of 140,000 dirhams. And just like that, we've solved the mystery of how to calculate true wealth for a business. It's never just about who has the expensive espresso machines. It's entirely about the balance between what they own and what they owe. Section 5. 3 Steps to Mastery. From now on, whenever you encounter a balance sheet in the real world, you just need to follow these 3 straightforward steps. Step 1. Find the total assets. Step 2. Subtract the liabilities. Step 3. The answer you're left with is the net worth, also known as the owner's equity. It really is a beautifully simple and systematic process. All right, it is time for a very quick review. I highly encourage you to test your new skills right now. If a company's assets are 900 dirhams and their liabilities are 300 dirhams, what is their net worth? Go ahead, take a quick second to do the math in your head. Well, if you calculated 600 dirhams, you are absolutely correct. 900 minus 300 leaves us with a net worth of 600. It just reinforces the complete, elegant simplicity of this financial formula. Perfect. Okay, now for one final review question to really cement the core lesson of this explainer. What is the name of the financial statement that shows a company's financial position on one specific, frozen date and time? The answer, of course, is the balance sheet. If you got that right, you can securely consider yourself a newly minted balance sheet master. You now know exactly how to look past the surface-level cash and shiny equipment to find the true financial health of literally any entity.
We have covered some incredible ground today, but I want to leave you with one final, pretty provocative thought. If your assets are growing every single year, maybe you're buying better cars and bigger houses, but your liabilities are secretly growing twice as fast to pay for them, are you actually building wealth or are you just financing an illusion? Remember, the balance sheet always knows the truth. Thanks so much for joining us for The Explainer. Keep asking the right questions and keep building true wealth.